We are digging into the incredible performance of Uranium Energy Corp, a ticker UEC.
Yeah, it's been quite the ride.
I mean, this stock has seen staggering growth. We're talking a 6-month return of plus 175.2%,
Right.
which just dramatically outpaces the S&P 500. That's sitting at what, roughly 17.9% over the same period?
Huge difference. Really stands out.
So today we are analyzing a strong buy recommendation. And it's got a specific 12-month price target, $19.75. The mission here is to understand why analysts think UEC has, made this shift.
Yeah.
From being a speculative developer to, well, a production-ready, vertically integrated U.S. champion.
And what's fascinating here, I think, is that this feels bigger than just market momentum, right?
How so?
UEC seems to be the single best-positioned asset to capitalize on what looks like an irreversible split, a geopolitically driven bifurcation of the global nuclear fuel market.
Okay, bifurcation, meaning splitting apart.
Exactly. Driven by geopolitics, national security concerns, this isn't just a cyclical bump. It's looking more like a structural realignment.
Okay, let's unpack this then, starting with Pillar 1, this geopolitical premium.
Right.
We know the global uranium market's structurally tight, but the pressure really skyrocketed, didn't it? Because of sanctions, the need to decouple from Russian fuel.
Absolutely. And U.S. policy is now aggressively pushing to re-domesticate the whole fuel supply chain. It's become a national security issue.
And UEC, being the largest U.S.-based producer, they're kind of the go-to solution.
They are the scaled solution to that imperative, yes.
Yes.
Which leads directly to the second pillar, operational success.
Right.
Fiscal year 2025 was really the turning point. That's when they, officially shed that developer label.
How? What changed?
They successfully restarted their Christensen Ranch operations up in Wyoming. That's in situ recovery.
Yep.
And they actually achieved their first drum production of yellowcake, that's UERO, back in February 2025.
Okay, first production, that's key.
Yeah.
Now, how exactly does their operational model, this ISR, give them an edge over, say, conventional mining?
Well, they use what's called the hub and spoke in situ recovery method, ISR. So instead of digging massive pits, they inject a solution, basically lixiviant, into the ground. It dissolves the uranium in situ right there in the ore body.
Ah, so no big digging.
Much less surface disturbance. Then they pump that uranium-rich liquid to a central processing plant, like their Irigaray facility, for processing. It's significantly cheaper, generally speaking, and usually has a lighter environmental footprint than traditional open pit or underground mining.
Got it. So cost-effective, less disruptive. Now, connecting this to the bigger picture, they just launched United States Uranium Refining and Conversion Corp, URNC.
Yes, URNC, that's the third pillar, vertical integration.
Okay, vertical integration. So
Yeah.
when you say that, what specific bottlenecks are they actually trying to tackle? Going from the yellowcake, the URA, all the way to UR-red conversion.
They're aiming right at the highest margin, most specialized bottleneck in the fuel cycle,
Which is?
the converted step. So UR is the yellowcake they mine. That needs to be refined and then converted into uranium hexafluoride, URO gas. That URO is what goes into the centrifuges for enrichment.
And that conversion step that's been dominated by
Historically, Russia has been a major player, along with others like France and Canada. By building this domestic end-to-end capability, UEC transforms itself. They go from being just a miner of yellowcake
It's just something more strategic.
to a strategic industrial partner, exactly, an end-to-end solution provider, potentially.
Okay, let's tackle the money side. Because the financials, at first glance, can be confusing. The reported fiscal 2025 GAAP net loss was negative $87.66 million. That looks like a major red flag if someone's calling this a strong buy.
It does look like one, but you have to understand the context. That loss was essentially strategically planned.
Planned loss. How does that work?
The real insight here is timing. UEC opportunistically sold a chunk of its inventory, 810,000 pounds, in the first half of the fiscal year. And they got a great price for it, $82.52 per pound.
Okay.
They took those profits, that cash, and then intentionally reinvested it, spent it, in the second half of the year, specifically to fund the accelerated production ramp-up at Christensen Ranch and prepare the second hub.
Ah, so the loss reflects investment in future production.
Precisely. And the key thing underpinning all this is their financial fortress. As of July 2025, they had about $321 million in liquid assets.
Liquid assets, so cash and equivalents.
Cash, inventory, readily available stuff, and, critically, zero debt.
Zero debt. That's huge in a capital-intensive industry.
It gives them maximum flexibility. It allows them to maintain a 100% unhedged strategy, meaning they're fully exposed to rising uranium prices. They capture all the upside.
If we compare them briefly, say, to their main U.S. competitor, Energy Fuels, what's UEC's edge there?
Energy Fuels is a solid company, but uses more conventional mining and is also diversifying into rare earths. UEC's advantage is its sheer depth in ISR within the U.S. They have this huge portfolio, 7 fully permitted U.S. ISR projects. That gives them something like a decade-long head start just on the permitting front alone.
Okay, permits are a massive barrier to entry in mining.
Huge. But we need to be objective about the risks, too.
Absolutely. What are the key ones?
Well, first, there's valuation risk. The stock trades at a high premium to its net present value.
Right. You mentioned PNPV. Can you explain that metric simply? What does trading at, say, 2.3 times PNTV signal?
It signals the market is currently paying 2.3 times the calculated present value of all the company's expected future cash flows from its assets. Basically, expectations are baked in. Very high expectations.
Got it. High expectations priced in. What else?
Second, execution risk. It's significant. They're ramping up 2 ISR hubs simultaneously and developing this complex greenfield URNC conversion facility. That's a lot to juggle perfectly.
Doing multiple big things at once always carries risk. And the third?
Dilution risk. Because they maintain zero debt, how do they fund big growth projects like URNC?
Through equity raises, selling more stock?
Exactly. Like the $203.8 million they raised specifically for the URNC project. For the listener, why does that funding strategy pose a risk?
Well, issuing new shares increases the total number of shares outstanding.
Right. Which can dilute the ownership percentage for existing shareholders. And potentially it can reduce the earnings per share down the road unless those new projects generate really significant profits relatively quickly to offset the increased share count.
So, summing up the risks: high valuation, tough execution challenges, and potential dilution from funding growth.
Those are the main ones, yes.
So pulling it all together, this strong buy thesis, it essentially argues you have to look past the standard backward-looking quantitative models, right? The ones that might flag the recent loss or the high valuation multiples.
That's the core argument. We think the market might be underappreciating 2 key qualitative factors that could justify that premium.
Okay, what are they?
First, the geopolitical premium. The idea that secure, reliable U.S. origin uranium pounds will command a significant, maybe even nonlinear, price premium over potentially less secure sources.
A premium for security of supply. Makes sense. And the second?
The integration premium. That URNC initiative, building out conversion capacity. It's not just adding another step. It fundamentally transforms UEC into potentially a much higher margin, more strategic industrial partner for utilities.
So the thesis hinges on geopolitics and strategic positioning, not just current mining output.
That's a good way to put it.
Okay, so to summarize this deep dive, UEC looks positioned as, well, an indispensable strategic infrastructure asset, almost like it's in the right place at the exact right time for these market shifts.
I think that captures it. And maybe a final provocative thought for listeners to chew on.
Go for it.
Just consider how heavily dependent our future energy grid might become on a secure domestic nuclear fuel supply chain. Think about base load power, grid stability, and even new demand like these massive electricity-hungry AI data centers everyone's talking about.
AI's power needs are enormous. That could be another driver.
It absolutely reinforces the potential long-term necessity for what UEC is building.
A compelling point. As always, the final investment decision rests with you, the listener. We've laid out the analysis, the context, the risks. We'll be back next time with another deep dive into the source material.